Hello and welcome to my next NAP. NAP stands for Nonprofit Auditor Points and I'm your nonprofit auditor. My name is Irina Oshkova and I'm a CPA and auditor serving nonprofit community. I designed these NAPs to help nonprofit community, its leaders, management and governance body, board, to understand better accounting, auditing, and financial issues. How to read financial statements, how to understand financial statements, and how to understand accounting pronouncements. These videos are not authoritative. This is simple me sharing my experience as an auditor, as a CPA, working with nonprofits, what nonprofits hopefully can benefit from. And today I want to discuss one of 3 letters that auditor issue at the end of the audit. In my previous snaps, I discussed the letter representation letter, a letter of communication to governance to the board. Please review those snaps. Hopefully board will find them very useful. And today I will talk about management recommendation letter. Okay, let's start. Management recommendation letter. Sometimes it's called just recommendation letter. Sometimes you will see it's called communication of significant deficiencies or communication of significant deficiencies and material weaknesses. So what is the purpose of that letter? We as the auditors have to communicate to the management if we as an auditor identified any areas of concern, meaning any areas where the management can improve and make it better. This is internal letter, and typically that letter is not distributed to outside parties. It's specifically for the management. However, we are aware that some funders do ask for the copy of the letter. A lot of nonprofits, I would say majority of nonprofits, pay attention to this letter more than they pay attention to the audit report, because audit report is dry and they typically just provide that to the outside parties. But communication letter or letter of significant deficiencies, material weaknesses, this is the letter that management see as a value-adding product, as something that they can really work on and improve the system of internal control inside the organization. During the audit, we as auditors, we do not test the system of internal control. What do I mean by internal control? Internal control means we do not see whether or not the organization procedures efficient or effective. We do not issue an opinion that we think it's a good internal control, it's working internal control or not. But we as the auditors, we have to understand the system of internal control. For example, for cash disbursement procedures, who initiates the cash disbursement, meaning where the invoice coming from, who receives invoice, who reviews the invoice, who authorizes invoice for the payment, and finally who pays invoice, who signs the check, who records the payment in the accounting system, and who performs monthly reconciliation to make sure that the check or payment has been cleared. So it can be done by one person, by 2 people, by 3, 4, 5. There's procedures who is involved in process and how that works. And we as the auditors, we need to understand what is cash disbursement procedure is, cash receipt, meaning how revenue is collected and recorded and so forth. But we do not issue an opinion whether it's internal control efficient or effective. It's for regular audits. We're not talking about compliance audits, for regular audits. When we understand these controls, sometimes we see that some procedures are apparently incorrectly designed or designed in a way they do not prevent fraud and can actually needs to be changed or improved. We also very often see that some procedures on the surface to be reasonable result in a lot of material adjustments that we as an auditor issue at the end of the audit. So all these factors make us believe that the system of internal control, whatever it is not working correctly inside the organization. Therefore, as a result of the audit, we do collect all these factors and we issue our recommendation to the management to pay attention on specific areas that we as auditors identified and change the system of internal control to mitigate the potential mistakes, errors, fraud, or dishonest behavior. So as you can see, this letter, the same as the previous letters, which is management representation letter, communication to governance, and audit report, they all have to be dated the same. This is the date when the auditor issued the audit report. And you can see another date. This is the date for the year end when the audit was done. So in this case, audit was done for September 30, 2023. And we as auditors issue this letter. So we're communicating to the management that based on that audit that we performed, in accordance with auditing standards, general accepted in the United States of America, and we considered the system of internal control of the organization. We considered, it's very critical. But our consideration was very limited, for limited purpose. We only used consideration of internal control to issue the report where the financial statements not materially misstated. And our procedures were not designed to identify deficiencies in internal control. So we do not specifically look for deficiencies in internal control. But we came across some deficiency. Therefore, we're talking to the management that it could be that some material weaknesses and significant deficiencies exist that we did not find because our procedures were not specifically designed to look for them. But regardless, we came across to some of them that we want to bring to your attention. And we explain it to the management. What is the deficiency? Deficiency in internal control exists when the design or operation of control does not allow management or employees in a normal course of performing their assigned function to prevent, detect, and correct any misstatement. So good system of internal control will allow you to locate mistake and fix it. Okay? Then if there is a combination of deficiencies in internal control that indicates that it's not just one-time mistake, but it's also a system of control mistakes, creates significant deficiency. And finally, material weakness. Material weakness, it's a combination of deficiencies of internal control that material enough that if it happened, financial statements will be materially misstated. Material errors. So meaning if anybody will rely on the report that has material weaknesses, might rely on incorrect material numbers. Okay? So therefore, we use as auditors, we use these three gradations: deficiency, significant deficiency, and material weakness. I know the name sounds very scary, and I did record the whole nap about the difference between deficiencies, significant deficiencies, and material weakness. This snap is not specifically explaining the difference, but just understanding the letter overall and what management needs to do about this letter. So if you want to understand better what significant deficiency and material weakness is, please review my another NAP on that specific areas. So after we explain to the management what is the purpose of that letter, we are saying to the management, we identified the following material weaknesses. Reminder, material weaknesses, it's a worst deficiency, because that material weakness makes financial statements to be materially misstated. And very often auditors issue material weakness when we identified material adjustment correction. And so, for example, we reporting to the management that financial closing and reporting process was not correct, meaning that at the end of the audit, at the end of the year end, when the organization was closing the books, it did not perform sufficient procedures to close correctly the balances and record all the adjustments. We also then saying we identified other deficiencies that actually significant deficiencies, meaning they're less, they're not as bad as material weakness, but they're also very critical to consider. For example, we're saying that the client does not recognize revenue correctly. Therefore, they need to consider how to improve their system of internal control, make sure that revenue is recognized correctly. We're also talking about accounts receivable not recorded correctly, but again, we did not identify any significant material misstatements. Therefore, it's not material weakness, it's just significant deficiency, and we're providing the recommendation. We also found some areas of improvement for special event revenue recognition, for accounts payable, property and equipment, and so forth. So the most important for the management and the board member, maybe audit committee, to review recommendations for every deficiency that we identified. You can see we provide recommendation. Management needs to read recommendation, understand recommendation, and see how that can be implemented. Maybe it can be implemented fully, maybe somehow differently, but it will also address the same issue, or maybe you would disagree with the finding of the auditor. But typically in our case, and hopefully for the most audit firms, before we put in recommendation letter, we already discussed with the management and they agree with those recommendations. So look at the recommendations, see how they can be addressed, and make sure to implement them, especially if they relate to material weakness and significant deficiency. Work with your bookkeepers so you can address and pinpoint what needs to be done to fix it. Those recommendations. Now, then lastly, so we did talk about material weakness, significant deficiency, and lastly we're saying we also found some other deficiencies which are not significant and not material, but we want to bring to your attention because they're good to improve internal controls and operating efficiency. So those just simply recommendations. Truly. So we gave recommendation about retirement benefits, concentration of credit risks, that some balances were not FDIC approved, and that's it. And we provide our signature. Now, again, so this is the letter. I know a lot of board members and management review that letter, but very often they do not understand the difference in between material weakness, significant deficiencies, and just other deficiencies. They also do not understand what responsibility of the management, and I would advise management to take this letter with a gratitude and understanding what can be done better. Work on that with your team, with the board, with the bookkeepers to improve the system of internal control. Again, it's not the auditor job to audit the system of internal control or issue an opinion on the system of internal control. But during our work, when the auditor come across of some corrections, adjustments, or very obvious inefficient control procedures, it's our requirement to communicate it to the management. And as a result, we issue a communication letter of significant deficiencies, material weaknesses, and other deficiencies. Thank you so much. Thank you for listening to me, and I hope to see you next time for our next snap. Have a wonderful day. Talk to you soon.